In classical corporate finance, environmental, social, and governance, or ESG, criteria are often viewed with deep suspicion through the lens of agency theory. Agency theory is an economic framework that examines the costly conflicts of interest between a company's managers and its profit-driven shareholders. The core friction is simple. Traditional economists interpret aggressive corporate social spending as a classic agency problem. They assume managers deploy corporate cash on environmental initiatives to build their own personal reputations, rather than maximizing shareholder returns. This assumption frames capital allocation within a corporation as a strict zero-sum game. Every dollar spent on non-financial reporting is a dollar that cannot be deployed elsewhere. Specifically, it means capital diverted to social compliance is capital removed from research and development. Research and development, or R&D, represents the high-risk, high-reward investments a company makes to engineer new products and secure future market share. To a strict classical economist, an overemphasis on ESG reporting looks like a self-imposed tax on a company's ability to innovate. To test this assumption, we have to look at one of the world's most aggressive economic environments, the Chinese capital markets, between 2011 and 2019. Researchers analyzed a massive dataset comprising 7,146 samples from China's A-share listed companies, specifically measuring the relationship between their environmental disclosures and their technological output. This scatterplot challenges classical agency theory. The x-axis represents the Bloomberg ESG score, while the y-axis tracks physical patent applications. A line of best fit shows a strong positive correlation. The empirical record proves higher ESG scores directly correlate with higher technological output. We are going to decode the econometric pipeline, showing how ESG signals actively fund high-risk R&D. Modern capital markets treat transparency as the strict prerequisite for technological dominance. We can derive this causal model by starting with the source of the market signal, the firm's ESG disclosure score. Next, we must accurately measure a firm's innovation capabilities. The critical flaw in traditional analysis is measuring R&D spending. Spending is merely a capital input. It guarantees nothing about the success of the engineering. The true metric is technological innovation capabilities, or TIC, measured by the volume of registered patent applications. We break this TIC node into two categories: substantive technological innovation, or STI, for high-end original inventions, and non-substantive technological innovation, NSTI, covering basic utility updates. A fixed effect regression is a statistical model that controls for constant, unobserved variables across entities to isolate true correlations. The baseline fixed effect regression on this data reveals that ESG disclosure has a statistically significant positive impact at the 1% level across all forms of TIC. We can now draw a solid causal arrow connecting the ESG disclosure score directly to TIC. Before examining the mechanics of how this happens, the baseline math is clear. Good ESG scores consistently predict higher volumes of actual, physical, technological invention. To understand the mechanism, we must address the practical reality of corporate finance. R&D is notoriously difficult to fund externally because the engineering process is highly complex and the commercial outcomes are deeply uncertain. This creates a severe information asymmetry between a company's internal engineers and its external investors, resulting in massive capital friction. Investors hesitate to fund projects they cannot fully evaluate. Economists measure this specific friction using the Financing Constraint Index, or FCI. The FCI is a metric developed by Hadlock and Pierce that calculates a firm's difficulty in obtaining external capital based on exogenous factors like firm size and age. Here, the mediation effect occurs. ESG disclosure acts as a powerful market signal, reducing information asymmetry. It proves strong internal governance to lenders, lowering perceived default risk. Because of this risk reduction, we insert a central node, the Financing Constraint Index. High ESG scores drive down the FCI node, reducing financing constraints. Consequently, this reduced FCI drives up the TIC node. A lower FCI provides abundant capital to develop patents. ESG disclosure secures investor trust, which then provides the cheap capital necessary to fund actual innovation. This leads to a critical strategic question. Does this pipeline yield the exact same return on investment for every type of industry? To answer this, we introduce the first subgroup, green industries, comprising environmental enterprises and resource extraction firms. On the top track, the arrow connecting ESG to TSC shrinks. We encounter a paradox. ESG disclosure promotes innovation significantly less effectively in green industries than it does in non-green ones. The economic reason lies in public externalities. Green innovation creates massive public goods, like cleaner air or water. Because the firm cannot capture all the financial upside of these shared public benefits, the internal economic drive to convert capital into high-cost patents is diluted. We can contrast this immediately with the high-tech industry classification. Here, the causal arrow pulses brightly and connects directly to substantive innovation. High-tech firms leverage ESG disclosures to signal operational stability, attracting venture capital for high-end inventions. Industry structure dictates the value of ESG. It is a capital magnet for high-tech firms, but structurally less efficient for green firms facing public good externalities. At this stage, we must address the ultimate quantitative skeptic's argument, the endogeneity problem. Endogeneity occurs when an explanatory variable correlates with the error term, obscuring whether A causes B or B causes A. Skeptics argue reverse causality. What if highly innovative companies simply have excess resources to hire consultants and write ESG reports? Researchers break this mathematical feedback loop using an instrumental variable, specifically a two-stage least squares regression. Two-stage least squares, or 2SLS, is a statistical method that uses an external variable to isolate the pure causal effect of an independent variable. The specific instrument used here is a two-period lagged ESG score. Because the past cannot be changed by present innovation, dropping this instrument into the equation isolates the pure causal effect of ESG. Researchers then applied generalized method of moments dynamic panel data estimation. Generalized method of moments, or GMM, is an econometric technique used to verify the robustness of parameters in dynamic models. The GMM test confirmed that the original 1% significance holds true. The data proves a strict one-way street. Pro-social corporate decision-making precedes and structurally causes the technological innovation that follows. Reviewing the finalized model in its entirety, we track the distinct flow of capital. Bloomberg ESG score leads to lower information asymmetry, which yields a reduced financing constraint index, ultimately funding substantive patents. For corporate strategists, the operational reality is clear. ESG disclosure serves as a core mechanism of capital formation. For institutional investors and financial analysts evaluating firms, this creates an immediate takeaway. A company's transparency regarding non-financial data is a direct, measurable proxy for their ability to survive the high costs of future R&D. To evaluate a firm's ESG score is to evaluate the resilience of its future capital structure. Zooming out from the individual firm to the macroeconomic scale, these findings carry implications for emerging markets. Economies like China are currently attempting a structural transition, moving away from resource-heavy output toward high-quality, innovation-driven development. At a national level, a lack of access to finance operates as a primary obstacle to this economic evolution. Capital markets are systems of trust, and ESG disclosure is the standardized language of that trust. In the global race for technological dominance, the companies and economies that embrace transparency will be the ones that attract the capital required to invent the future.